Welcome everyone to ALTA's latest Insights webinar. These are our free presentations offered on issues important to title and settlement professionals. I'm Jeremy Yohe, ALTA's Vice President of Communications, and today we've got a fantastic webinar lined up to look at the 2021 housing market, looking at information about the economy, labor market, demographics, and the housing supply. Also looking at the effect COVID is going to have on the coming year. And just wanted to thank you all for taking a little time out of this historic day as President Joe Biden and Vice President Kamala Harris were sworn into office. Definitely a tough act to follow this afternoon, but confident our speaker is going to provide a great overview for this year's housing market. Before starting, I need to touch on a few housekeeping items. Just as a reminder, all participant lines are muted for today's discussion. If at any time you have a question, please submit them through the questions box. We'll hold some time for Q&A at the end of the presentation. As an added benefit, the webinar is being recorded. A recording will be available on ALTA's website at alta.org/webinars. Again, that's alta.org/webinars. You'll also get an email tomorrow with a link to the recording. You can download a copy of today's presentation from the handout section there in your GoToWebinar window pane. And in the email you'll get tomorrow, you also have a link to access the presentation as well. And with that out of the way, let me introduce today's speaker. Joining us today is Odeta Kushi. Odeta has joined us, I think this might be year 3 in giving the housing market forecast. Odeta is Deputy Chief Economist for First American Financial. She conducts research around demographic trends, millennials, and homeownership. And she also monitors and analyzes quarterly surveys and economic data related to the housing industry. And with that, Odeta, I'll turn the presentation over to you.
Thank you so much, Jeremy. I'm so happy to be here. So thank you for inviting me into ALTA, for allowing me to speak today. It's certainly a big act to follow in terms of following the inauguration, but again, I'm excited to be here, and we'll be going through a lot of content today. I'm sure you're probably tired of hearing of it, but 2020 was an unprecedented year. But for the housing market, it was an especially strong year because of the housing market fundamentals. And I'll get into those a little bit later in the presentation, but I'm going to start out the presentation with a discussion of the broader economy and how that was impacted by COVID and what it might look like going forward. We'll go into the labor market a little bit deeper, and then of course we'll talk about the supply and demand dynamics within the housing market and what they imply for 2021. So let's just jump right in and talk about the economy. And I think what you'll find that the thesis in this section is that health and economic welfare are inextricably tied to each other in our services-dominated economy. And I'll talk about what that means in a little bit. So anyone who's seen my presentation before is maybe familiar with this chart. Here we're looking at every recession since the Great Depression indexed to 100 at the pre-recession peak. So the x-axis is showing you how long it took for us to get back to normal in terms of economic size, and the y-axis is showing you the depth of that recession. Now, most recessions will contract our economy by about 2 to 3%, and we'll get back to normal in roughly 5 to 7 quarters. Now, that deep blue line that you see there, that's the Great Recession, which before this 2020 downturn had contracted our economy the most, and that was about 4%. And it took longer than 2 years to get back to normal, again, in terms of economic size. Now, since then, we were in the longest economic expansion where we gained about 22 million jobs, but of course, that ended once the pandemic hit. So let's take a look at our 2020 decline. In 2020, we know that GDP tanked in the second quarter, and that was due to the wide-scale shutdowns, the massive layoffs, and consumer uncertainty. All of those things are significant drags on consumer spending. Now, beyond the third quarter of this year, I've actually included consensus forecasts from the Wall Street Journal. We know that there was a swift rebound in Q3 GDP from the economy really starting to reopen. So consensus forecasts from the Wall Street Journal show that the U.S. economy will grow by 4.3% in 2020 after likely having contracted by 2.5%. It will grow by 4.3% in 2021 after likely having contracted by 2.5% in 2020. Now, the main reason behind this kind of positive outlook is the belief that a rollout of vaccines will eventually put an end to the stop-start cycle of business restrictions. So there will likely be a surge in economic activity and hiring by the second half of 2021, and there will be particular strength and rebound in the services sector. Additionally, there's more than $1 trillion in excess savings built up during the pandemic that can be used to satisfy pent-up demand. In other words, Americans may very likely go on a spending splurge once the pandemic is over, which would lead to a nice boost in jobs and income. So this consensus forecast actually puts us at pre-COVID GDP levels by the end of 2021. But as I mentioned at the start of the presentation, the economy will follow the path of the virus. And so the primary concern is getting the virus under control. Okay, so let's talk about what made this recession different. I've said services quite a few times already, and this recession was different from previous recessions in that it was services driven, so specifically leisure, transportation, and hospitality. Now, in most recessions, services are basically acyclical, while the decline in investment is much more severe. So compare the stability of services in this chart, which is that orange line, to the annual percent change in private investment. You can see it collapsed in the last few recessions. And here I've actually zoomed in into 2020 through Q3 of 2000 through Q3 of 2020. So one of the reasons that services are so acyclical is that services can't be stored. So in order to consume services during a recession, they must be purchased. An example I like to use is that during a recession, you can drive your old beat-up car a little bit longer, but your hair continues to grow. So oftentimes during recessions, we'll see layoffs in manufacturing workers, but we won't see layoffs in barbers. Barbers won't necessarily lose their jobs. But this is the recession for the services industry. And before this downturn, that was 131 million workers, making up 86% of our total non-farm employment. And so a shock to the services sector, a sector that's so labor intensive, is like nothing we've ever seen before. And so those in the industry, hospitality, retail, leisure, they felt the sharpest economic pain in this downturn. But this also helps to explain the dramatic nature of the downturn that we saw. All right, well, we can't go too far into an economics presentation without talking about the Federal Reserve and rates. So here we're showing the federal funds rate in relation to the dual mandate of the Fed, and that dual mandate is full employment and a target inflation, so stable inflation. Now, neither of those goals are zero. The unemployment goal is about 4.5%, and the inflation target is 2%. So in this chart, we've actually adjusted unemployment and inflation for their Fed targets. Today, unemployment's at about 6.7%. We're not quite at our goal, and core inflation is at about 1.4%, so well below the Fed's 2% target. Now, we know that during turbulent times, the Fed has two main levers that it can pull. It can lower the federal funds rate, and it can institute quantitative easing. You can see that's exactly what they did in the aftermath of the Great Recession in order to stimulate the economy. And then again today, the Fed's taking a page out of their 2008 playbook. Fed benchmark short-term borrowing rate is anchored near zero, and the Fed continues to buy at least 120 million in bonds each month. So the Fed's purchasing treasuries and mortgage-backed securities. The purchase of mortgage-backed securities is one of the reasons that mortgage rates are so low today, which has been very, very good for the housing market. Now, the Federal Reserve has indicated that it will continue to purchase mortgage-backed securities, which will put downward pressure on long-term yields and thereby mortgage rates. So the consensus in the industry for mortgage rates in 2021 is about 3%, with that lower boundary at 2.7 and the higher bound in the low 3, so 3.3%. So low mortgage rates will continue to boost house buying power and keep purchase demand robust. I'll talk about this a little bit later. I'll even address kind of the higher mortgage rates that we saw in the last week or so. So the Fed has made it abundantly clear that rates are anchored near zero until the job market reaches full employment and inflation has risen. And in fact, their approach to inflation is that the Fed will not raise rates even if unemployment falls below levels that historically would have been considered a warning sign for pricing pressures ahead. So low rates are likely the new norm for the foreseeable future. Okay, so I wanted to touch on, while we're still on the topic of the economy and GDP, I wanted to touch on housing's contribution to GDP. And housing's contribution to GDP has actually increased during the pandemic. In fact, in the second quarter, while the broader economy was struggling, housing accounted for more than 60% of the overall GDP number. And then as the rest of the economy recovered in the third quarter, that share declined slightly to 15.5%. But even with that, with the exception of that second quarter, this is the highest share for housing since 2008. Now, home building and renovation accounted for about 3.5% of the total GDP, and then rent, utilities, and the imputed value of shelter or imputed rent accounted for about 12% of total GDP. So that total number, that share of housing, yes, it's still less than before the Great Recession, but that's largely because of a lack of home building, which has not yet returned to the levels of the early 2000s. The good news is that housing should remain a bright spot in 2021, as it was in 2020. Low interest rates and a lack of inventory support more building. And we'll talk about this a little bit more in the presentation when we really dive deeper into housing specifically. Okay, so now it's time to talk about the labor market and kind of what labor market experienced in 2020 and what we might expect going forward. But I first wanted to address some more recent data. So this is the most recent unemployment insurance report, which shows that total initial claims, both pandemic unemployment assistance and regular initial claims for state benefits increased. Now, the increase in PUA, which is the pandemic unemployment assistance, that goes to self-employed, gig workers, and other workers who don't qualify for state benefits. That rise, part of that rise probably comes from the fact that people know that this program will still be available to them. But regular, non-seasonally adjusted initial claims for UI benefits are now back above 1 million again, which is worse than at the height of the Great Recession. And continuing claims, as you can see from this chart, also increased in the most recent report. So that number had been declining throughout the summer and into the fall as a lot of laid off workers were recalled back to their jobs or found employment elsewhere. But the economy follows the path of the virus, and as virus cases have surged, there's been a stalling in the labor market, especially as businesses started to close up once more. The other thing to look for in these reports are signs of long-term joblessness. So here we're looking at continuing claims through the PEUC program, Pandemic Emergency Unemployment Compensation Program. And that pays up to 13 extra weeks of jobless benefits beyond the state's traditional 26 weeks. And then we're also looking at the Extended Benefits Program. And while the PEUC declined slightly in the most recent report, the Extended Benefits Program increased and hit above 1 million. Now, keep in mind that a portion of the fall in the PEUC is probably people that have exhausted that benefit and are rolling into the Extended Benefits Program, because the Extended Benefits Program is for when regular and PEUC are exhausted. So these are programs that are monitoring to have a better understanding of long-term joblessness in the economy, right? Because there is a sign that that 2021 is off to a slow start when you look at these high-frequency labor market metrics. But as I mentioned before, we do think that the economy and the labor market will gain momentum as the vaccine spreads, because again, the labor market follows the virus. And what you're seeing here in the increases are due to more restrictions aimed at combating the virus. So another sign that the labor market recovery is in a little bit of trouble is when you look at the jobs report. So here we've indexed each recession to peak employment and when employment was able to get back to its peak level. And that bright red line is obviously the current recession, reflecting data through the December jobs report. Now, in December, non-farm payrolls declined for the first time during the recovery, and that fell by 140,000 jobs, while the unemployment rate held steady at about 6.7%. Now, the Great Recession is in that gold color here, and what made that recession so scary was both the depth and the duration of the job losses. The 2020 recession has the sharpest decline, but it's likely that the duration will be much shorter, and we've recovered just over half of the 22 million jobs that have been lost during the pandemic. But as I mentioned, in the December jobs report, employers cut 140,000 jobs, marking the first decline since the pandemic hit last spring. And leisure and hospitality really bore the brunt of that decline. They shed about 498,000 jobs, and that was really due to the surge in COVID infections, because it really forced a lot of restaurants and bars to either close completely or scale back operations. And over 3/4 of that decline was actually concentrated in food services and drinking places. So the December jobs report once again was heavily concentrated in lower wage industries, particularly leisure and hospitalities. These were industries that were hit hardest at the onset of the pandemic, but were on the rebound until this month's report. So this is a sign of pandemic-induced job losses again. Another sign of the return to pandemic-induced job losses is that after months of falling, there's been an increase in the number of people on temporary layoff in December. So these are reversals. These reversals are really a sign that the most recent surge in COVID cases is resulting in a return to pandemic-induced job losses. So I wanted to decompose that December jobs report a little bit. So this is a month-over-month change in jobs. You can see from this very clearly that job losses were heavily concentrated in leisure and hospitality, and they were partially offset by gains in professional business services, retail trade, and construction. I wanted to narrow in a little bit more on the construction piece because in that last report, residential construction jobs increased just over 1% relative to the previous month and are actually now just about 1% above their pre-pandemic levels in February. And as I'll talk about later in the presentation, increasing the number of construction workers is critically important to alleviating the labor shortage and really starting to build more homes, which is absolutely necessary in our housing market today. So continuing a little bit more into the labor market, obviously the loss of jobs was incredibly concerning, but another sign that is concerning are the millions of people who are now considered long-term unemployed. So the number of long-term unemployed, so those jobless for 27 weeks or more, accounts for 37% of total unemployed as of December. The last time that the long-term unemployment ballooned was during the Great Recession, and at that point, it was hovering around 40% of the overall jobless population from about late 2009 into 2013. And that was the highest in the series' 73-year history. So what is the potential implication of long-term unemployment? Well, permanent economic scarring and a prolonged recovery. Those who are unemployed for a long time tend to obviously experience a decline in their income. They might have to dip into their savings. And being out of work for a longer period of time, it becomes harder to find a new job. Employers may be less likely to hire someone who's been out of work for a long time, and worker skills may start to erode, or the worker may even begin to be discouraged. But as I mentioned, there is light at the end of the tunnel. The rollout of a vaccine in 2021 will help to alleviate a lot of these hardest hit sectors, specifically airlines, hospitality, leisure, retail. It'll help those sectors recover, which will provide a real boost to the labor market, obviously faster growth skewed to that service sector. So I'm going to kind of connect the labor market and the housing market, because the only major sector one of the only major sectors during the pandemic to display immunity to kind of the economic impact of COVID is the housing market. It experienced a strong V-shaped recovery. And this is largely due to the fact that this has been a services-driven recession, disproportionately hurting younger, lower-wage renters that are less likely to be homeowners or home buyers. Potential home buyers and existing homeowners are much more likely to be a part of the higher wage work from home sectors that have been much less impacted by pandemic-driven job losses. So this chart is actually showing you that total low-earning job losses in the third quarter were down nearly 10% relative to the first quarter in 2020, while the total high-earning job losses were only down 2.7% relative to that first quarter. So this bifurcated landscape has allowed potential homeowners who are still employed to channel the increased savings that they've built up towards buying a home and taking advantage of record low mortgage rates. And I want to dig into this a little bit deeper because at the onset of the pandemic, we wanted to try to understand how this recession would impact the housing market. And obviously the unemployment rate is often used as a proxy for the extent of economic hardship. You know, the more households with unemployed members, the higher the aggregate level of economic hardship. However, once we started to dig into the data, we found how important it was for us to distinguish between renters and homeowners when trying to analyze who this labor market decline will disproportionately hurt. So the figure here is showing you the difference in the unemployment rate between homeowners and renters since the year 2000. And what we found is that homeowners are much less likely to be unemployed. And even in times of economic distress, the rate of unemployment for homeowners doesn't increase as dramatically as it does for renters. In fact, since the year 2000, the unemployment rate for renters has averaged nearly 4.5 percentage points more than for homeowners. This gap really widened during and in the aftermath of the Great Recession. And the main reason for this is that homeownership is highly correlated with being older and more educated, which also reduces the likelihood of being unemployed. Now, this recession has exacerbated this divide because it is a services recession, disproportionately hurting younger, lower wage renters. And this is a look at the owner and renter unemployment rates during the course of the pandemic. Now, we're using a slightly different data source here, which is why I didn't include it in the previous slide. It's not directly comparable, but it is important to note that using the Census Pulse survey data to measure renter versus owner unemployment rates, you can immediately tell that renter unemployment rates have been consistently higher than homeowners since the survey began in April, and even through the most recent survey in late December. That gap hovered around 6.5 percentage points in the spring to early summer and has since fallen to about 5 percentage points. So this is higher frequency data and more real-time data to give us some more insight into this bifurcation. Now, I mention all of this because the return to pandemic job losses in the December jobs report means that the lower wage service workers are being hit again. This obviously poses long-term economic risks, but the resiliency among higher wage jobs still supports a strong outlook for the housing market, and is one of the reasons that the housing market was so resilient to the economic decline in 2020. So I want to switch gears a little bit and talk about the demographic tailwind. In my bio, I'm sure you saw, I study millennials, and millennials are really key to the housing market today and looking ahead. And so let's dive right in and talk about the homeownership rate, and specifically the millennial misnomer. So I want to start out with the homeownership rate because in the next slide, I'll be decomposing it a little bit. Now, homeownership in the 90s really remained consistently within the 63, until the 90s rather, remained within the 63 to 65% range. And then in the 90s, through a variety of ways, homeownership rose dramatically. Now, the recent decline after the crisis has been largely economically driven, but also partly because young households are being formed primarily as renters and driving down the share of household homeowners relative to the total. So not all of that decline that you see there resulting in the low point in 2016 is due to the crisis. A lot of it is demographically driven, and I'll explain what I mean. To understand why the homeownership rate declined until 2016, it's important to start with the basic components used to calculate the homeownership rate itself, the number of rented and owned households. So the homeownership rate is just the number of owned households divided by the total number of rented and owned households. So as you can see, since the end of the recession, we've been consistently creating rental households. That's that green line there, at the expense of owned household formations. Millennials have been busy doing what generations before them did, which is to rent first. This is your younger millennials aging out of school, out of their parents' homes, and increasing that rental formation rate. This alone will reduce the homeownership rate because, again, you've increased that denominator. Then starting in 2016, you see this trend started to reverse. Now we're forming a lot of owned households. That's your older millennials aging into homeownership. I also want to call out that the second and third quarter data points there, we're taking those magnitudes with a grain of salt due to changes in increased data collection. But nevertheless, we do believe there's a longer run demographic shift away from renting to homeowning that is being driven by millennials aging into homeownership, and most recently accelerated by historically low mortgage rates. So another way to look at this is by decomposing the homeownership rate by age cohort. So this is the year-over-year percentage change in the homeownership rate by different age buckets. Millennial demand for homeownership was one of the biggest trends characterizing the housing market in the last few years. Households under 35 and those between 35 to 44 years old had the highest year-over-year growth in the homeownership rate, and this trend does not show any indication of reversing in 2021. In fact, as more millennials age into their early to mid-30s and begin to get married, have children, form households, they will continue to be primary drivers of homeownership demand. Now, this is not to say that millennials are not lagging behind their generational predecessors. They certainly are. This chart is showing you the homeownership rate by generation. So the homeownership rate for millennials between 25 and 35 is approximately 6 percentage points lower compared to their predecessors, the baby boomers and Gen Xers in the same age group. However, this difference can largely be explained by different lifestyle choices. Delayed lifestyle choices delay the desire for homeownership. Millennials have delayed marriage and having children in favor of investing in their education and pushing their marriage and family formations to their early to mid-30s, compared with previous generations who primarily made these lifestyle choices in their 20s. Now we're finally starting to see the older millennials settle down, have kids, and buy that first home. And as I'll talk about in a little bit, their education is starting to pay off as well. Well, I just answered the question, but what are millennials doing that's making them push these decisions later in life? Well, they're busy getting educated. This is the percent share of the population with a bachelor's degree or higher by generation. And it's very clear from this chart compared to their predecessors that millennials are the most educated generational group. And the clear trend here is that millennials are being educated earlier in life as well. But of course, education takes time and it takes money. And that is the subject of the next slide, because the natural question after, well, they're very educated, but doesn't all of that education come at a cost? Yes, it does. It's true that between 1992 and 2019, average student debt increased dramatically from nearly $13,000 to just over $40,000 in 2019 inflation-adjusted dollars. Student loan debt is actually the second highest consumer debt class behind mortgages, higher than both credit cards and auto loans. So certainly all that education does come at a cost, but it's important to dig a little bit deeper into that number, because in that same time period, the median payment to income ratios remained relatively unchanged at about 4%. So how can it be that the overall debt level is so much higher, yet the payment to income ratio is is remaining the same when you look at the median? Well, first, the average inflation-adjusted income for young households with student debt increased from about $63,000 to $83,000 between 1992 and 2019. But much like a mortgage, monthly student loan payments depend on more than just the loan amount and the borrower of the income. So the average repayment term for student loan debt has also nearly doubled from 1992 to 2019. Which is keeping that payment to income ratio down. Because just like going from a 15-year mortgage to a 30-year mortgage allows you to borrow more money for a similar monthly payment, almost doubling the student loan repayment term accommodates more student loan debt for similar monthly payment. And then at that same time, interest rates have declined. From 1992 to 2019, the average annual interest on a student loan has declined by 2 percentage points. And so again, that's also helped to keep those the payment to income ratios steady over time. Of course, an important question to consider is whether the reason for this debt, the education, is worth the investment in the first place. And the answer, according to our research and as this chart shows, is yes. Higher educational attainment generally leads to higher household income, which translates into increased house buying power. Now, in 2019, which is what this chart is reflecting, the difference in house buying power between a millennial with a high school degree and a millennial with a bachelor's degree was approximately $225,000. So this helps to explain why the homeownership rate in 2019 among millennials with a bachelor's degree was nearly 7 percentage points higher than the homeownership rate among millennials with a high school degree. So Student loan debts have increased over time, but student loan buying power has also increased sufficiently to keep the monthly payment burden from increasing. So this is one of the reasons why student loan debt is more likely to delay rather than prevent homeownership. So with student loan debt burden moderated by stable payment to income ratios and a significant return on investment from higher education accruing to the most educated generation yet, millennial demand for homeownership is expected to continue and really drive homeownership demand looking ahead. And that's good because the future of the housing market is critically important on the buying patterns of today's millennials. So this chart, we are forecasting the net new owner-occupied households or first-time homebuyers formed by today's millennials. So this forecast is actually a lower bound of demand. We're not taking into consideration higher educational attainment and higher incomes. And what this forecast is showing you is that in the next 10 years, millennials will likely be responsible for at least 15 million home sales. And again, this is a lower bound of demand because the higher educational attainment among millennials should yield higher incomes and subsequently higher homeownership rates at future ages than the historical averages. But this is good because, again, the market is critically reliant on the buying patterns of this generation. I also wanted to show where millennials were moving. So this data is a little bit more backward looking. We're looking at annual net migration of millennials between 2012 to 2017. And in this chart, you can see that millennials were mostly moving towards the sun and some semblance of affordability. So you see our Texas cities are gaining a lot of millennials, whereas LA, specifically LA and New York City, are facing some of the highest losses. Now, the other thing I wanted to mention is that even prior to the pandemic, there was a movement from larger metros to smaller metros and from urban cores to suburbs and exurbs on the part of millennials, because as millennials have been aging into these key lifestyle decisions associated with a greater likelihood of purchasing a home, marriage, family formation, many have already made the shift to the suburbs. So we sought to see if the data confirms that the pandemic has accelerated that trend. And we looked at the top markets in the United States. And in October 2019, annual median home sale price growth was greater in suburban zip codes compared with urban zip codes in just 3 of the top 10 metropolitan areas in the US. But by October 2020, annual median sale price growth was greater in suburban zip codes relative to urban zip codes in 5 of the top 10 markets. And in 2019, within the markets where suburban zip codes outpaced the urban, the average difference was about 1.5 percentage points. That difference increased to 8 percentage points in 2020, most of that driven by New York City. So while this trend does suggest an acceleration to the suburbs in some of these markets, it's important to note that median sale price changes can also be caused by changes in the overall mix of the homes being sold rather than reflecting true value changes. But we decided to dig into New York, right? Because New York is really emblematic of the slog to the suburbs phenomenon. But as we've mentioned in some of our research, New York is leading the city for the suburbs is not necessarily a new phenomenon. As homebuyers begin to prioritize, strong public schools and more space for their families, demand for the suburbs grows. So you can see how we broke out the urban, suburban, and rural zip codes in the New York CBSA in that left-hand chart. And then you can also look at the growth rates and sale prices in the urban zip codes versus the suburban zip codes in the chart on the right. And from that chart, you can clearly see that the suburban zip code sale price growth was much higher than the urban sale price growth starting in the spring of this year. And so that really does kind of point out that there may have been an acceleration to the suburbs in New York specifically. But again, all of this is very difficult to prove without an all else held equal analysis. Now, it is worth noting that home builder activity does reflect home buyer demand, and the National Association of Home Builders has found that single-family construction has been growing fastest in small metro suburbs and lower density markets in the second quarter of 2020. So there is some evidence of a suburban shift for consumer home buying preferences. So switching gears again, I wanted to talk about why this time it's different, or maybe it's why last time was different. Many still bear scars from the Great Recession, and when the pandemic hit, many people were expecting the housing market to follow a similar trajectory in response to the COVID outbreak. But there are distinct differences that indicate the housing market would follow a very different path. So I want to start out by talking about forbearance. Because despite the federal foreclosure moratorium, there were initial fears that up to 30% of homeowners would require forbearance, ultimately leading to some kind of foreclosure tsunami. Forbearance did not hit 30%, but rather peaked at about 8.6% and has been steadily falling since. And in spite of the record-setting spike in unemployment, foreclosure activity in 2020 has actually plunged to an all-time low. Now, that has a lot to do with the fiscal stimulus and obviously the foreclosure moratorium. So, since the peak in early June, where 8.6% of all mortgage loans were in forbearance levels have fallen. In the most recent report, that number was about 5.5% of mortgage loans. So there is still a risk to the housing market. And in the most recent report, we also found that the share of loans in forbearance declined for each investor category, which is good. Forbearance will likely follow the path of the labor market. That's something that I think has been emphasized time and time again. So if we don't see massive improvements in the labor markets, and we shouldn't necessarily expect to see significant improvements in forbearance rates as well. And touching more on how homeowners have been impacted and into homeowner distress, we decided to look at the 15 markets tracked by the Census Bureau's Household Pulse Survey. That's that left-hand chart over there. And from that chart, you can see the most recent report in December that Houston, Texas, and Riverside, California had the highest percentage of distressed homeowners, followed by New York, Dallas, and LA. So a way to read this chart is, for example, in Houston, 30% of homeowner households reported that they had no or low confidence of making their next mortgage payment, or they would defer payment. Now, the share of homeowners uncertain in their ability to make their mortgage payment has declined since peaking in the summer, but as with forbearance levels, it remains too high for comfort. And many are concerned about what this means for the prospect of foreclosure. But there are many reasons to believe that a wave of foreclosures or a foreclosure tsunami is unlikely to happen. And we like to describe this through something called the dual trigger process, because foreclosure is a two-step process. First, the homeowner suffers an adverse economic shock, such as the loss of income, leading to the homeowner becoming delinquent on their mortgage. However, not every delinquency turns into a foreclosure, because with enough equity, a homeowner has the option of selling the home, or those with stable incomes can tap into their equity through a refi to help weather the economic shock. The reverse is also true. If the homeowner has little equity in their home, but suffers no financial setback that leads to delinquency, there's no need for foreclosure. So again, this is what we call our dual trigger hypothesis. Alone, economic hardship and a lack of equity are each necessary but not sufficient to trigger a foreclosure. It's only when both conditions exist that a foreclosure becomes an outcome. And of those 15 markets reported in the Census Pulse Survey, homeowner equity is greater today in 14 out of 15 markets compared with the second quarter of 2009, which was the trough of the Great Recession. So while homeowner distress is measured by the unemployment rate is actually much higher in these markets today, the equity levels are also much higher today. So the likelihood of foreclosures is much, much lower. So if distressed homeowners are required to resolve delinquency, given their equity buffers, involuntary sales are much more likely than foreclosures. So we are very likely to avoid any kind of wave of foreclosures or foreclosure tsunami because of that equity buffer. And I'll dig into that a little bit deeper at the national level. But one of the main ways that housing is different today than it was at the onset of the Great Recession is that housing is not overvalued today. So the way that we're measuring overvaluation nationally is comparing the median sale price of a home with the median house buying power. So how much one can buy based on changes in income and interest rates. If housing is appropriately valued, median house buying power should equal or exceed the median sale price of a home. The only time period in this chart you can see when the median sale price was greater than the house buying power was from 2005 through 2007, indicating an overvaluation of housing or a housing bubble. Now today, house buying power is nearly twice as high as the median sale price of a home, implying that housing is certainly not overvalued and is in a much better position in this recession than it was ahead of the last. So we also decided to dig into the market level. So this is October 2020 data comparing median house buying power and median sale price. And in this, we find that of our top 50 markets, only 3 are considered slightly overvalued, and they're all in California, Los Angeles, San Francisco, and San Jose. The other difference is that that the housing market is in a much stronger position today compared to the decade ago. Is obviously we have more rigorous lending standards, but also the household debt to income ratio is at a 4-decade low. And that's what this orange line is showing you is mortgage debt as a percent of disposable personal income. Remember that your average homeowner is carrying less than a 4% mortgage rate. So this is a lower monthly debt burden, and that can help homeowners bridge a period of unemployment for longer. Americans today also have record levels of home equity. So here we're showing 2 different things. We're showing the ratio of total mortgage debt outstanding relative to the value of the U.S. housing stock. That's a mouthful, but think of that as a national LTV. And that's currently at 36%, compared with 54% on the eve of the Great Recession. So in a much better position today. Also, homeowners today collectively have almost $20 trillion of equity, which provides them with a very strong economic buffer. And then, of course, housing is currently underbuilt rather than overbuilt. So this chart is showing you the supply and demand for homes. You can see that supply was higher than demand until 2009. That's when the situation reversed. So here, in order to calculate supply, we're looking at single-family, multifamily, and manufactured housing construction, and we're subtracting units lost due to various causes. We're estimating about 1.3 million households formed in 2019. Compare that to the supply of just over 900,000 units. We are significantly underbuilt, and household formation is likely to continue to grow. So we really need to see new home building begin to pick up the pace and start to keep up with the increase in demand. And that takes us to the big short in housing supply, and jumping right into the supply shortage. So there's a ton of demand in the market. We know this: low mortgage rates, millennials aging into prime home buying years, but there's no supply. You know the story very well. It's all over the news. And this chart is showing you just how bad that supply crunch is. This chart is looking at existing and new inventory of homes for sale. And then that orange line is the measure we call inventory turnover. That is the total supply of homes for sale nationwide as a percentage of occupied residential inventory. Now, a quick look at that will show you that we are at a historically low level of 1.27%. That means that only 127 homes in every 10,000 were for sale, and that's well below the historical average of about 2.5%. So, existing home sales make up the majority of all homes for sale. And we saw in the most recent existing home sales report that month supply hit a historic low of 2.3 months. So as existing homeowners have withdrawn their supply, average tenure length, or how long someone lives in their home, has soared to a historic high of about 10.5 years. So ultimately, rising tenure length means there are fewer homes on the market. And as demand has surged, the competition among home buyers for the small amount of homes has gone up and driven prices up. So if there aren't enough homes for sale, then why don't we just build more homes? Well, builders are trying. Home builders are trying to respond to the supply shortage. And in fact, November's report shows that housing starts for single-family homes is up 27% relative to last year. That was the highest pace since 2007. Permits for single-family homes, which are a leading indicator of future starts, increased as well. So these were welcome signs of new single-family inventory to come. But building will really have to exceed household formation for a number of years to really start to reduce the household stock debt, if you will, that we've accumulated. Now, I just updated this chart this morning because we received a new builder confidence report, and this chart is showing you that builder confidence and single-family housing starts. And single-family housing starts, that report comes out tomorrow. Builder confidence is still exceptionally high, but has recently fallen. So in this morning's report, rising material costs led by an increase in lumber costs, along with the resurgence of COVID, pushed home builder confidence down for newly newly built single-family homes. But again, this is still historically high. Builders are responding to low mortgage rates, they're responding to an increase in demand, and they're responding to the fact that there's very few existing homes available for sale. So wanted to show quickly that lumber is one of the supply side headwinds to builders building more homes. National Association of Home Builders earlier in 2020 put out a report that said that the spikes in lumber prices caused the average price of a new single-family home to increase by more than $16,000. And lumber prices are again on the rise. So builders are facing multiple supply-side headwinds. Obviously, rising material costs like lumber, that's one, but lack of buildable lots. And then the other one is burdensome regulation. I won't go into every single category here. This is a National Association of Home Builders survey done in 2011 and 2016. But it shows that on average, regulations imposed by government at all levels account for 24% of the final price of a new single family home built for sale. And so again, builders are trying to keep pace with the demand. They want to build more homes, but they're facing multiple headwinds in the way of higher material costs and burdensome regulations and lack of lots. And also a lack of workers, which is why I mentioned at the beginning of the presentation that the increase in residential construction workers is good news for the industry. I also wanted to take a look at what the industry was forecasting for housing starts. So here I'm actually taking the average forecast from Fannie and MBA and NAR to see what single family starts and multifamily starts might look like going ahead. And the story here is really that we'll see a steady increase in single family housing starts, but just a bit of a decline in multifamily starts. But again, the housing industry has been in a chronically underbuilt situation through the entire post-Great Recession era. So we really need building momentum to remain high. And I'm running short on time here a little bit. I want to leave time for questions, but I just have a few slides left looking at the housing impact. This morning, we got new mortgage application data from the MBA that's showing us that purchase applications are nearly 15% higher than a year ago. This is really great news, off to a really strong start in 2021 and really ended 2020 in great shape after hitting we were down 35% in mortgage applications in April and then made up for it. In fact, 2020 was a stronger year than 2019 in terms of cumulative purchase applications. This morning's report also showed that refi applications actually did pull back a little bit because refis are absolutely rate sensitive, as we know, and we've seen a little bit of an increase in mortgage rates, although still historically very, very low. So again, refis a little bit more rate sensitive, but purchase demand should remain incredibly robust because even if rates rise a little bit, still historically low. And then of course you've got your millennials aging into prime home buying years, and buying a home is a lifestyle decision just as it is a financial decision. So I won't go into this too much, but I wanted to touch on affordability quickly because house prices are usually reported nominally. And the way that we like to look at them is actually adjusting nominal house prices by mortgage rates and income. And when you do that, you find that affordability, at least in our most recent report, is still better than 1 year ago. And that's really thanks to really low mortgage rates. But in the last couple of months, the faster nominal house price appreciation is starting to erode the affordability boost from low mortgage rates. And so the question for affordability will really be what that dynamic will look like. Will nominal house price appreciation outpace the benefit from modestly rising incomes and low mortgage rates? So affordability is certainly something that we're watching in the year to come. And also wanted to highlight that we did this report looking at the market level, and we did find that there are quite a few markets starting in June through October where affordability did decline. And so you have those markets in green, Las Vegas, Cleveland, Kansas City, all markets where affordability has declined since the summer when the housing market really started to heat up. And I'm happy to send that report to anyone who's interested. Again, running a little bit short on time, so I want to make sure that I get through everything. And then, of course, we have I like to end on this slide, and that is how existing home sales and house price appreciation fare during recessions. I like to end on this slide, especially because it shows how well housing has performed in 2020. So in this chart, we show the impact on prices and sales of the most recent recessions. Each series is indexed to 1 at the start of the recession. So the y-axis is showing you the magnitude of response in percentage terms relative to the starting point, and the x-axis is showing you the duration. So what's striking in many of these recessions is that home sales were barely down or even slightly up. But even more interesting is that house prices really don't skip a beat. You know, they really show their downside stickiness, which means they don't show a decline. And why is that? Well, that's because in the housing market, sellers often will withdraw supply rather than sell at lower prices. Which is why we didn't see lower prices during the housing market's pandemic plunge in the early spring. Of course, the exception is distressed selling. House prices declined in the 2008-2009 recession because homes are overvalued, mortgages were a little bit riskier, and homeowners had very little equity, which resulted in an increase in foreclosures and distressed selling. So you saw house price declines then. But heading into 2020, we saw appreciation was fueled by something very different. It was fueled by record low mortgage rates, income growth for those still employed, and demographic demand and low rates. These are trends that we anticipate will continue in 2021. So we do expect housing to remain a bright spot in 2021, again, because of these housing market constants: low rates, millennial demand, and ultimately an improving economy due to the distribution of the vaccines. And so I will end there. You can find our research at firstname.com/economics. I'm also very active on Twitter at Odeta Kushi. And we actually just recently started a podcast called the Economy Podcast. So please subscribe to that. You can find that on our website as well. So I'm going to turn it back to Jeremy to field any questions.
All right. Well, thank you, Odeta. A great insight in the 2021 housing mortgage market. Lots of numbers to crunch. Just so you know, Odeta was updating the charts this morning with as she said, some data that just came out. So you've got the latest data at your fingertips. And as she kind of concluded, 2000 Q4 numbers aren't in yet, but 2020 is expected based on the rest of 2020 as far as title printing volume. Maybe one of the best years in history. Probably have similar results in this year with a higher percentage of purchase originations, offsetting the decrease in refi activity. So as we mentioned, we'll hold a little time for questions. Submit them in the questions box. We'll get them pitched to Odeta. But we have had a few come in so far. Odeta, one on the Federal Reserve. Phil asked. He said the Federal Reserve increased the money supply by $3 trillion in 2020, but we haven't seen the needed velocity. If the government puts $1 trillion in the hands of people who will spend it, won't inflation jump significantly? And how would the Federal Reserve adjust to this?
Yeah, so really inflation is the question, right? Investors are curious about what's happening to inflation because ultimately, what will the government be able to do if inflation rises? They might have to increase taxes. But inflation really has not been much of an issue. And in 2021, there's still a lot of concerns about the economy. There's still, demand, low demand to some extent. And so the Federal Reserve, I think, is taking the approach of, well, let's wait and see. Let's wait and see if we start to see a pickup in inflation. Right now, the primary concern is getting our labor market under control, getting the economy under control, and we'll deal with inflation as it comes. People have been waiting for inflation to come for some time, and it just hasn't. We've been struggling to get to that 2% inflation target, and so I think it's kind of a wait and see approach.
Definitely a lot of wait and see for this year. It's inauguration day. President Biden's in the office now, and as we were chatting before, you're an economist, not a political pundit, but we have had some questions, just in general, curious as to your thoughts on how the Biden administration will affect the housing market. Biden has proposed a home buyer tax credit that could help with some down payments. So, thoughts on how that could drive activity?
Yeah, so I've been reading about the tax credit, and that's helpful on the demand side, of course. Millennials, first-time home buyers have repeatedly noted that a down payment is their biggest hurdle to homeownership. So I think Biden is trying to address that part of the market. But I think what we need to start paying attention to is supply. We have a lot of demand in the market, right? I mean, we see that in the numbers. Record low mortgage rates are bringing people off the sidelines, increasing purchasing power. And so we do have a lot of demand. I think what needs to be addressed is the supply side of the equation. How do we bring more homes on the market? How do we make it easier for builders to build? How do we work with state and local municipalities to try to make it easier for builders to build? And so that's kind of that's what I'm looking for in the administration. I don't know the answer. I don't know what that'll look like. I think ultimately for the housing market, it's the stronger fundamentals that will drive the market. Now, what we are seeing is an increase in long-term yields, and that's driving mortgage rates a little bit higher, right? If you look on housing news, all you'll see today and yesterday is the fact that mortgage rates have risen a little bit. Still historically low, but a little bit. And that's really because the market's responding to, we talked about inflation earlier, the potential for inflation, but also potential a better economic outlook coming from the vaccine, coming from potentially more stimulus money. And so mortgage rates are climbing a little bit higher because of that. So not directly political necessarily, but certainly investors respond to what's going on domestically, abroad, in politics, and that will have an impact on mortgage rates because it will have an impact on yields, on the 10-year Treasury yields. Long-winded answer.
No, you're going to say, and actually kind of a follow-up from Eddie along the same vein, looking at the competing factors. So Eddie says, many indicators of struggling economy, extended benefits are rising, unemployment high. However, there's good economic news. Housing demand rising, consumers are spending. The stock market is still surging and strong. So he was wondering if you could summarize, how to reconcile these opposing stories. Are there basically two economies with the haves and have-nots, and has the pandemic widened that gap?
Yeah, so there absolutely has been a bifurcation in the labor market, as I mentioned earlier in the presentation. And so there is a lot of excess savings in the market right now. Think of the people who didn't lose their jobs and, we're not going out to restaurants anymore, and we're really able to build up that savings. Some of that savings can be redirected to the stock market. And so we have seen a rise in that sense. And then, of course, you have the people that have been disproportionately hurt and are now being hit again in this latest report. And that's really a function of the business closures and the rise in COVID cases. And so I certainly think that the way to reconcile those two things is by studying the bifurcation that's been happening in the labor market. And that, actually helps to explain why the housing market's been so strong as well.
We think about the labor market and how that could affect purchase activity. More Americans are rethinking, where they call home as remote work grows.
Right.
We'll continue to do this. Do you think that would drive, more home sales in more affordable markets and shift, where activities traditionally happen?
So I don't subscribe to the death of the cities idea. I do think that once COVID is over, people will be drawn to the amenities that cities offer. I think time and time again, there's been especially New York City, it's like, well, everyone's leaving New York, and New York, no one will ever come back. And time and time again, people return to New York. So there will be, as I said before, changing preferences that are largely demographically driven as millennials are aging into having a family and wanting to move out to the suburbs. I think that will continue. And then we might see a little bit of an exaggeration in some of the bigger cities, and the increase in remote work, as you mentioned, might allow some people to live further from their workplaces. And so I think we'll start to see a little bit of that happening, but I certainly do not believe in the death of the cities. I know I, for one, love DC's amenities and truly enjoy being in the city. So,
all right, to each their own, where they enjoy living, whether a city or by the ocean, or for me in Ohio.
Exactly. There you go.
One more question. We are at the top of the hour, but maybe just to get back to a little bit of the people in the call are going to see at the closing table. You touched on millennials making up the largest share of home buyers. You expect that trend to increase even though, as more of them age into home ownership?
Yes, we absolutely, the bulk of the millennials, this is the largest generation, 72 million, and the bulk of that generation turned 30 in 2020. And so we still have a lot of millennials aging into their early 30s. And again, as they push these lifestyle decisions later in life, they've also pushed home buying into their early 30s. And so we definitely expect millennials to be a driver of home buying demand, a large driver of home buying demand going forward.
All right, thank you, Odeta. If we didn't get your question or something comes up afterward, feel free to email me, jyoe@alta.org, and reach out to Odeta and get it answered, or follow her on Twitter. We'll see what she's saying. If you missed parts of today's webinar or think others in the office would benefit from listening, as I mentioned earlier, recording will be available on ALTA's website, alta.org/webinars. And again, you'll also get an email with a link to the recording. And with that, that will bring us to the conclusion of today's presentation. Odeta, thanks again for providing us the latest on the housing market forecast.
Thanks so much for having me. It was a pleasure. Thank you, everyone.
All right. Thank you. Take care, everyone.